think the rest of the world is looking at this asset class and saying, well, this is no longer a tier one reserve asset. It's on its way out. The US gross amount of debt will be pushing probably $40 trillion in the next couple years. At this point in time, I don't think that there's another currency, various different countries, that is that large and really, I think that the world would trust. And so it's moving into gold.
It's Wednesday, April 1st, and according to headlines, Trump and Iran are in negotiations. No, this is not an April Fool's joke. This is a headline I'm reading right now. Trump says Iran's president asked for a ceasefire, but the U.S. wants Hormuz Strait open first. Okay, well, markets are up right now, and it seems like markets are up every single time such an announcement is made. And then it goes back down when the exact opposite happens. So we'll talk about why markets are behaving the way they are and what's next for metals, commodities, and the global economies. Brett Heath joins us once more. He is a CEO of Metalla Royalty. Welcome back to the show. Good to see you, Brett.
Thanks, David. Thanks for having me.
This was the headline I was reading. And let me just show my screen right now. This is from CNBC. And it seems that the U.S. will consider the offer. Apparently there's an offer put on the table by Iran for a ceasefire. Now, recall that 2 weeks ago, Iran has rebuked any such claim that they're in negotiations. So we'll see what's happening now. But what is your take on how the markets are reacting to this news, especially gold? And we'll focus on gold and the metals today. Gold seems to be going up every single time there's good news. 5 years ago, when I was starting off in the industry, that would have seemed abnormal or strange, that gold responds to good news positively and bad news negatively. Should have been the opposite. But let's comment on why it's doing this right now.
Yeah, David. I mean, gold is historically, it's always confused investors in the press and so forth. You know, gold always acts in anticipation of whatever is going to happen in the future. So it's 3, 6, 12 months sometimes ahead of where everything is moving today. You know, when you saw the war in Iran fold and all of a sudden gold was moving down, it was very difficult for a lot of people to understand. You're like, what's going on? There's a big war now. There's all this geopolitical uncertainty. Gold should be rallying. But ultimately, gold was rallying kind of in preparation of that. You saw that big move. You know, gold was kind of understanding, you know, people kind of closer to better sources of information usually have access to lots of gold, and they're moving gold or they're moving other capital into gold, getting out of dollars and so forth. So, you know, I think the move down in gold kind of post the war starting was really just a short-term kind of liquidity issue for a lot of the Middle East countries in regards to kind of the short-term need of cash. Not necessarily any kind of longer-term, you know, thesis in regards to, you know, changing a view of why they own it. Like you're continuing to see most global central banks net buyers of the metal today. And I think outside of kind of a small circumstance, that'll continue even for all of the Middle East and region itself over time.
I'm going to show you a chart of gold, and this is gold overlaid with copper. They're moving pretty much exactly in tandem here. Copper is the blue line while gold is the bar chart. Now I'm going to overlay this with the SPX, S&P 500 index. Less of a direct correlation, but you can see, especially since the beginning of 2026, major sell-offs and rallies have coincided together, all three asset classes. It seems a little bit odd, but that is the market that we're living in today. Brett, perhaps what we're seeing right now with gold is just it's reacting to people selling everything off at the same time and buying everything all at once. And gold isn't really acting on its own right now. Could you make that assessment?
I mean, I think what we're seeing here is we're seeing just a shift. We're seeing a shift, like if you back up and look at kind of more of a longer term perspective, we're in the middle of this shift from financial assets to real assets. So, you know, gold is moving higher, commodities are moving higher. Gold kind of was the first one to move. You're seeing copper get pulled with it, but you also now recently have had energy move with it. You're seeing agricultural commodities move with it. You're also seeing, you know, fertilizers move with it. So all of the different parts of the commodity sector is now starting to move in tandem with gold. And again, it's really that shift. It's that shift of capital flows from financial based assets. It's that shift from kind of the old guard, if you will, within mainly kind of U.S. listed equities, like Mag 7 kind of leading that capital flows out of those equities. Um, into emerging market equities, into more commodity-based equities, and I think gold will continue to be the driver here. When you look at just the chart of gold by itself, and you look at a monthly chart, you can kind of back out a lot of this noise, and it just looks like it continues to be in a really strong uptrend. It looks like it continues to have a very significant bid, underneath it. And I think we're going to see it go higher by the end of this year.
Significant bid by whom? Who's buying gold right now? Do we know?
I think central banks, I mean, outside of the Middle East region, I think central banks generally are net buyers of gold. Have been over the last couple of quarters. You also see institutions like Tether that have come in and been the largest gold buyer in the last 2 quarters. Probably will continue to be in Q1 of 2026. Actually larger than all the central banks. So what you're seeing just the shift again. Like if you back it up, like you still have $9 trillion worth of U.S. Treasuries held by foreign central banks on their balance sheets. And, I see most of that moving into gold. If you look at kind of the trend, it has been moving into gold over the last 1 to 2 years in a pretty meaningful way. And that looks to continue. But that's a pretty significant amount of capital that still needs to migrate into an asset class that is clearly, in my view, becoming the world's global reserve kind of tier one asset.
Why would it need to become a tier one global reserve asset in 2026 and beyond? Don't we have the dollar for that, is the argument. And indeed, we've seen the DXY spike up after the Iran war broke out. So why does gold need to fill that role, you think?
Well, gold fills that role mainly because of the view of what the let's just call U.S. Treasuries as a risk asset. When you look at U.S. Treasuries as a whole, the U.S. deficit is going to, or the U.S. gross amount of debt will be pushing probably $40 trillion in the next couple years. When you look at what's happening at the long end of the curve, I would say that is the canary in the coal mine of this whole situation. As the war in Iran has unfolded, you've seen the long end of the curve go up. Now, what does that mean, and are the implications of that generally for the fiscal situation in the U.S.? Well, what it means is that as they have to roll over all of the existing treasuries, which this year is approximately $9 to $10 trillion just in 2026. They're being forced to the short end of the curve, which is going to increase and compound what they're going to have to roll over in 27 and in 28 and 29. And basically, this refinancing wall is just going to be compounding on itself as they're going to have to push more of this debt into shorter term T-bills and probably at the longest on the note section. So when you look at kind of that compounding, again, you look at the ability of not only that, but to fund the deficits. I think the rest of the world is looking at this asset class and saying, well, this is no longer a tier one reserve asset. It's on its way out. At this point in time, I don't think that there's another currency or another debt market within various different countries that is that large and really, I think that the world would trust. And so it's moving into gold. Gold is no one else's, has no counterparty risk. It's the next kind of largest, most liquid market, and that's kind of where things are going. And I would say that most of the buyers are not price sensitive either.
Nobody talks about the cost of being right too late. Not the cost of being wrong, the cost of being right. Seeing something coming, understanding exactly why it was going to happen, and then watching it happen without you. Well, gold has gone from $3,000, then to $4,000, then to $5,000 in a very short amount of time. And a lot of people watching this right now knew that this was coming. They felt it in their gut. They understood the deficit spending, the central bank buying, the writing on the wall, but their retirement account never reflected any of it. That is the gap we need to close today. JP Morgan is projecting $6,300 gold price this year. Central banks are not pausing their gold buying, and the people who look back without regret will not be the ones who were the most informed. They will be the ones who actually did something about it. My friends and sponsors at Priority Gold created a free precious metals playbook that shows you exactly how to add physical gold or silver to your IRA or 401k tax and penalty free. They handle everything. You just have to take the first step. So call 866-407-6456. That's 866-407-6456, or take out your phone and text David, D-A-V-I-D, to 24999. You can also scan the QR code here on your screen or click the link in the description down below. Again, 866-407-6456, or text DAVID to 24999. The 10-year yield that I have in front of me, the U.S. 10-year yield, has been going up ever since the beginning of March, right after the Iran regime got struck. So the bond market usually behaves this way in one of a few scenarios. One, the bond market believes that there's a economic growth ahead, and so an episode of economic growth would push yields up. Inflation is about to spike. That's case number two. Case number one and number two sometimes go in hand. Or perhaps the deficit or debt issues in the U.S. will widen. We saw that happen with Japan when the JGB yields went up right after the prime minister announced new fiscal measures that will increase debt and deficits. So what do you think the 10-year yield is signaling to you?
Well, just if you got a $40 trillion gross debt and your borrowing cost is average 5%, that's $2 trillion a year of interest expense. Okay, just to use some round numbers that I think potentially may be reached in the next kind of 1 to 2 years.
Well, $2 trillion, by the way, is the projection by the CBO by 2036. So I'm not sure if you read that projection, but that's pretty much spot on. But carry on.
On interest expense. And
Yeah.
interest expense is a function of where these rates are being refinanced. So currently, the average rate that the government is paying on that debt is around 3.7, 3.8%. Currently, those are falling off. They're being refinanced kind of north of that. So if you think about kind of the long end of the curve increasing, it's going to be difficult, again, for the government to be able to refinance and then continue to refinance this every single year. If they're, again, going to be forced to the shorter end of the curve, I think Trump's new Fed chairman likely is going to be cutting rates. And as they're cutting rates, it's going to be a situation where, potentially there could be some type of soft default or some type of restructure in the next kind of 2 to 3 years.
What does a soft default look like for the markets?
Well, a soft default wouldn't be it would be more of a restructure. So, for example, like
Okay.
they would reduce the rates, they would extend the term, they would restructure these debt instruments in a way where they would be able to continue to pay that interest. But ultimately, it's either printing the money and paying the interest expense and the deficits, which is just basically a devaluation of the currency, or they can look to kind of do some type of restructure. I know that the U.S. government or Scott Bessent specifically has mentioned something along these lines as an idea.
What keeps you up at night as not just the CEO of Metalla Royalty and Streaming, and I'll get to that, and I'll get to your company in just a minute, but just as an investor probably in capital markets? Anything that could go wrong with, well, I guess more wrong with the world than what we already have, that would really push markets sideways?
Well, you've got the private credit market that I think is due for a very significant kind of revaluation. That's about $2 trillion. And I think the market kind of shrugs that off a bit just in regards to the size of it. But if you think about the mortgage-backed security issues back in 2008 in the financial crisis, that market was not much larger than $2 trillion. Now, private credit is an asset class that is not marked to market. So valuations of these assets on banks' balance sheets across the board are at very, very significant different valuations for the same asset class. So what that tells me is that there could be some significant cracks in that market. Obviously, that will affect the banks And who knows exactly kind of how that plays into the balance of the financial markets. But that is something that I think we are watching, and I think could have an impact in regards to just the overall markets and so forth.
If the Strait of Hormuz doesn't open soon, what we're looking at is not just oil being choked, but other critical minerals needed and critical materials needed for other industries. For example, helium has been popping up in the headline as something that's needed for the semiconductor manufacturing industries, especially in Asia. Asian countries like South Korea and Taiwan import most of their helium from the GCC region. And so what we're looking at then, if that persists, is a potentially chip shortage. If the tech sector gets dragged down, that's bringing down the entire market. That's another risk. But in regards to the precious metals, at $4,800 an ounce gold, it's still hovering near its all-time highs, not far off from $5,000, and it's gone down about 20% since 5,500, its all-time high back in January. Do you think, Brett, that gold is repeating a 2011 pattern where it peaked, had a double top, and it came down? In other words, what are the major risks for gold right now?
Yeah, so I mean, being very, very close to the gold market, I monitor a number of different capital flows within the sector, and what I can say is that the market back in 2011 is nothing even remotely close to where we are at today, in regards to the capex cycle, in regards to kind of the speculative amount of investors and trading action within the equities of the sector. Also, the capital flows. If you look at some of the larger metals and mining ETFs, you're seeing net outflows. You're seeing net outflows even out of a lot of the bullion ETFs. And the reality is like there's not a lot of people that really own gold or gold equities. If you look at gold equities as a percentage of global equities, it's still sitting just under 1%. When you look at it, kind of what it was, 10, 20, 30 years ago in other speculative highs within those markets, you'd be looking at something in the 5 to kind of maybe 6% range. So I don't see that type of speculative behavior within the gold market. I think that the buyers of the metals themselves still have a lot more that they need to buy in order to diversify away from U.S. Treasuries.
In 2011, going back to that cycle again, there was a surge of M&A activity, which in retrospect signaled the market top. Maybe that was just timing coincidence, but as you recall, there was a surge of M&A, and then shortly after in 2012, the price collapsed and the entire industry slowed down. Comment on M&A activity today, and perhaps let's use that as a signal if applicable.
Well, the mining sector is still being very conservative with these gold prices. I mean, we look at where these companies are budgeting their mine plans for 2026. They're still budgeting in like the 2,000 to maybe up to $2,500 gold price. So I would argue that generally the sector is being very conservative. You're not seeing the crazy M&A type of behavior that you saw in any of the previous cycles, for that matter. And I think that generally, like we haven't really seen much of that. It's been a lot of smart kind of, I would say, well-placed M&A that's been there, really focusing around synergies and expanding margins and operating margins and so forth.
What kinds of projects has Metalla Royalty been focusing on in the last year, and how have these projects been, let's say, different in scale and scope from previous years?
Yeah, so we focused on very high quality assets since day one. So we've got a portfolio of approximately 100 different royalties, North America, South America, Australia. Our view is always that owning duration on very high quality assets was the way to really make the most money for investors and for shareholders. And when we look at kind of how everything has played out over the last 10 years, it's now all kind of coming together. As we see now getting further into this cycle, we're seeing higher and higher metal prices that significantly expand the returns that we're getting on the $309 million that we deployed all of which when gold was between around 1,100 to $2,000 an ounce. So kind of having that growth built in, bought and paid for in the portfolio, we're able to kind of leverage out these cycles, not just on gold, but copper as well. We've got exposure about 30% of our NAV, or about a third of the NAV of our portfolio, sits in some of the most highest quality copper development assets like Copper World and Taca Taca. While most of the growth between now and 2030 is going to be on the precious metal side, that'll be driven by assets like Côte Gosselin, assets like Castle Mountain, and others.
I just had a conversation with some friends. We were talking about AI and how none of our jobs are going to be safe, even if you're an entrepreneur. And my friend sent this list of companies, or not companies, but jobs most likely to be cut in the foreseeable future. Middle management, business, finance, accounting, blue collar jobs. And then he sent a list of companies or jobs that are most likely to be safe going forward. So plumbing, repairs. We've got blue collar jobs that are going to be safe because AI can't replace physical labor. And I counter with, well, robotics is going to be huge, and robots are going to be paired with AI, and that's going to do a lot of the repair jobs. It's happening already. We've got drones in Ukraine in the front lines. Anyway, the point is, we then concluded, what do we do as investors? And then my friend said, well, energy. None of this is possible without energy. What does that mean for you?
Well, I mean, look, I think that as AI continues to expand throughout various industries, it's going to create more productivity. It's going to make things more efficient. I mean, it's making things more efficient across our business already. Just the way that we monitor assets, we evaluate assets, like we're implementing the technology throughout our business, making things more efficient. I think in 10 years from now, you'll be able to put a large mine into production with probably 30 or 40 people, compared to, call it, three or four or 5,000 today. So I do think that it's going to create more productivity, but the difference with mining specifically is that the lead time to not only find, but prove and then permit and build is a very, very significant timeline. Upwards of 10 years for gold mines, and likely kind of 20 to 30 for major copper mines. And so I think we're going into a period where there's going to be more demand for all of these metals, specifically on copper from the new economy perspective, and then from gold, as it basically is going to play the reserve asset role going forward. And so, I think that Metalla is very, very well positioned. I think the best way to get exposure to these metals is in the ground. Governments cannot confiscate the gold that is in the ground. If you even go back to the early 1930s, when the U.S. government confiscated gold, the mining equities rallied, and the mining companies that were mining the gold in the ground were able to continue to mine all that gold, but now they were able to sell it at a much, much higher price. And I think that's going to be a similar situation. I don't think that the government's going to be confiscating anything this round, because I think that there's very, very few people that actually own gold today compared to what it was back in the 30s. But continuing to own and have exposure to these metals in the new economy over long periods of time. Like I said, most of our assets have an average reserve life of 20 plus years. So it allows shareholders to be able to kind of get exposure over decades, and you're owning that metal that's coming out of the ground. You're owning assets that continue to compound, completely free carried by the operators. Once you acquire royalty, there's no further capital outlay. So, the hundreds of millions of dollars that our operators put into our royalty properties in 2025 all found more gold. They extended mine lives. They made new discoveries. Significant amounts of value generated by those operators on these very high quality assets all flows through completely free carried to Metalla. And then as all of these assets start to come online, it's top line cash flow. So what we're seeing today is we're seeing investments that we made 3, 4, 5 years ago come online And given where the gold price is today, they're kicking off, almost our entire investment and probably will for the next 10, 15, 20 years. So it's an exciting place to be. I
Yeah.
think that the shareholder is very, very well positioned here
There's a
for
map of
for
your
this.
projects here around the world.
Yeah, that's correct.
Can you just explain to the viewer how a royalty business operates and just explain the business model from beginning to end? And then I want to ask you basically how you select projects. That's important. You don't want to be investing and funding a project that has no potential to produce down the line.
The royalty business is very simple. What we own are basically mineral rights. They're these non-dilutive interests. Now, if they're in the right jurisdictions, they go in perpetuity. And so you can kind of see from the map here that we've always focused on North America, South America, Australia, and in kind of the better parts of those jurisdictions where there is a rule of law. Because again, most of the value that I think investors are able to realize with royalties is actually what you can't quantify when you acquire them. And when you're buying really high quality assets, it's very often that you see significant increases in reserves, you see new discoveries. And so when we acquire these royalties, again, they're non-dilutive mineral rights that as the asset moves into production, there's no further capital outlay, so it's completely free carried. And once the asset's in production, you get your 1%, 2%, 3% of the metal that gets pulled out of the ground. And so over the last 10 years, we've built a portfolio up, I said, of approximately 100 of these different assets. The focus was always on development as we wanted to focus on the higher quality assets so the company would be in a position to really play the cycles. And ultimately, that's the business is playing the cycles. That's how these companies kind of continue to scale and grow over time. We heavy capital deployment in the down cycle, and now we're moving into the up cycle. Less transactions, more kind of allowing the portfolio to generate the returns, based on the macro thesis. And then eventually there probably will be another down cycle, and this portfolio will be kicking off, continuing to grow its cash flow, every single year for the next 10 years without even having to make one additional investment.
Are you more likely to deploy capital now and fund a new project at 50 or 5500 gold or $4,800 gold than just 2 years ago at half of the current gold price, Brett?
Yeah, it's a completely different proposition, as you're
Hmm.
well aware, given the movement in the gold price. I mean, I think how we're looking at things today and how we're looking at deploying capital in the call it the latter part of the cycle would be probably using or of use of more credit, meaning that like we can go into potentially larger transactions that are producing already that we could add a little bit of credit or a reasonable amount of credit to minimize the dilution as we continue to scale this business. And so that's kind of how we're looking at it. And I think that's kind of the best way to look at it in this part of the market because again, you don't necessarily want to be making investments that will impact the balance of kind of the portfolio that you acquired over the last 10 years.
Appreciate it, Brett. Tell us a little bit more about copper before we close off. Now, we mentioned how copper is critical for the energy transition. Just tell us a little bit more about why it's so critical. It's been labeled, it's not just my opinion, it's been labeled critical by the US government last year.
Well, copper, so I mean, for the investors out there that missed gold, copper, I think, is going to move this year. I think this is going to be the year you really see copper make a material move, similar to kind of what gold did or gold started to do back in 2024. And what excited us about copper, and this was a very, very long-term macro thesis that, took us to take a big position in these copper assets is that copper is in a very structural supply deficit, meaning that every single year, likely for the next 10 years, we're going to see less and less copper produced. At the same time, we see almost exponential demand as every single year goes by. We're seeing more demand use cases for copper. And you saw that early on from kind of green economy capex that has now moved into data centers. I think the next big use case will be robotics, but ultimately, when you think about how the infrastructure generally was put together 50 years ago, it wasn't built for this type of power distribution. I think ultimately that you're going to see a whole kind of revamping, restructure of the grid across most of the Western economies, which will add an enormous amount of more copper demand that I don't think is in anybody's models or expectations as of today. Now, the interesting part about copper, what makes it, I think, potentially so exciting is that the long lead times. You can't just put a copper mine, find a copper deposit, and put it in production in a year or two to be able to meet the increased demand that is out there, even if prices are materially higher. Now, there are some substitution risks and so forth with aluminum, and eventually I think the market will be able to kind of figure a way to kind of balance it out. But I think we're heading into a period where, we could see copper rise significantly higher than even some of the most bullish forecasts out there, given that the copper price will rise and there's going to be very, very little new supply that will be able to be met given the lead times on making, putting these new assets in production.
Thank you very much, Brett. We'll speak again soon and get us an update for the audience. Brett, tell us where we can find your work and follow your company.
Yes, you can go to our website, metallaroyalty.com. That has all of our information, and that's a great way to subscribe to our news releases and our media.
One final question before we go. Given your vision of the future and what the future is going to look like in 30, 40 years, or even long after we're both gone, Brett, does that change the way you position Metalla Royalties portfolio? Does that change the way you shift priorities in terms of which assets you want to invest in?
No, I don't think so. I think that generally, if you think about the metals that we have exposure to, these are metals that are going to be kind of core pieces of the new world going forward, probably many, many, many decades, if not potentially centuries. And you look at the assets that underline those trends, we want to own those. We want to own the trend where the most proven geological trends around the world that oftentimes have mines that go for 30, 40, 50, 60 years. If you look at Copper World as an example, which is going to be America's next major copper mine, we have a royalty on this asset. That is a 44-year reserve life. So I think that owning very high quality assets over long duration on kind of key commodities that make up the new economy is the way to kind of position. And obviously things change. You got to understand kind of what the impact of that is going forward. But generally, we want to have a really strong foundation. I think we've got that right now today.
Thanks so much. We'll put the links down below. Make sure to follow Brett and Metalla Royalty there. Speak again next time, Brett.
Thanks, David.
Thank you for watching. Don't forget to like, subscribe.